Welcome back to Watch Your Assets, where we've got your money on our minds. If you're new here, I'm your host, Stephanie Bracken. If you're not new, welcome back. This is part 2 of our insurance discussion. So I hope you all have your thinking caps on today. We're going to talk about 2 really popular types of insurance that I think most people are going to be familiar with. We're going to talk about property and casualty insurance. So that's going to be things like your home, your auto, umbrella coverage. And then we're going to talk about life insurance coverage and the different types of insurance coverages that are available to you. So just to refresh, if you haven't watched part 1, insurance, again, is the process of sharing or transferring risk of something, risk of some kind of loss, and you share that or you transfer that risk to an insurance company. So you say, hey, Progressive, I want your help insuring my car so that I'm not 100% responsible for the damages that are done to my car in case of an accident. So you tell the insurance company, hey, I want to pay a bit to keep insurance coverage in the form of premiums and your deductible, and the insurance company in exchange for that will also help with cost sharing whenever you are in, again, some kind of accident, regardless of what the source of that accident is, right? So let's talk about property and casualty first. So property and casualty is the process or the insurance coverages that are protecting things like, again, your home, your car, your boats. Jewelry can be a property and casualty. If you have an art collection, you can insure that. Fire coverage, things like that. So you're insuring the things that you, material possessions, as opposed to health insurance, where you're insuring your health or your life, which will be life insurance, of course. So you're insuring material possessions against loss. So a lot of people will insure things like their wedding rings to ensure that if something happens to it, that cost can, or that ring can be replaced. With these types of insurances, again, we're going to have deductibles, we're going to have premiums to keep that insurance policy valid, and depending on what you're insuring, the premiums are obviously going to vary, and your deductibles might also vary. So just keeping in mind that things like your car, your home, you should have some type of coverage on those because those are big expenses. Those are big assets that you have. And if something happens to them, you don't want to be responsible for the cost of completely replacing a $30,000, $40,000 car. So let's talk about car insurance first. With car insurance, there's a lot of different components that I think can be a little confusing, and I'm not going to necessarily talk about everything, but I want to at least cover things like personal liability, uninsured motorist. These are parts of your insurance coverage that protect you against different things. So, of course, uninsured motorist, if you get into a car accident and the person who hit you doesn't have insurance, this is where that coverage comes in. And so your insurance coverage can take the place of what their insurance was not providing, of course, if they don't have insurance. So that's a benefit that your insurance will start to pay given that you got hit by somebody who does not have insurance. Let's talk about tort. So tort is a confusing thing. There's a lot of different, when you go to select car insurance, there's a lot of different options that are part of your process of selecting the coverages that you want to keep on your car insurance. So with tort is something that has to do with going to court and the legal system, right? And I don't actually specifically know all of the ins and outs of tort, but I know that with limited tort, you're going to be able to not probably sue or get as much money as you could have for pain and suffering if you are in a lawsuit over a car accident. Versus full tort, you can sue for full pain and suffering and potentially get a higher payout from a lawsuit. However, full tort is much more expensive than limited tort. So if you're concerned about the price of your premiums, then that might be something to consider, and that's going to be something that affects your premiums. What are the chances that you're going to end up in a lawsuit? Probably slim, but you never know. So if that's something that you're concerned about being able to do, then maybe full tort is something that you want to keep on your car insurance. The other big piece, or especially for costs, another big piece of car insurance is going to be your collision coverage versus comprehensive coverage. So if you just have comprehensive coverage, that's going to cover you against things like hail damage, you hitting a deer or some other animal, things that are kind of outside of your control. They're acts of Mother Nature. Those usually have a $500 deductible or so, but you get to choose the level of your deductible whenever you're selecting car insurance. However, it will not protect you against someone hitting you or you hitting another car or a pedestrian or someone on a bicycle. So comprehensive is purely just acts of Mother Nature will be covered, but if you are hit by somebody, that won't be covered under your collision or your comprehensive insurance. That's where collision insurance comes in, and this is a big part of your premium. So depending on the deductible that you select, this is going to be what jacks up the price of your premiums a lot of the time. So with collision insurance, of course, that's going to be the thing that protects you against you getting rear-ended, someone runs a red light and T-bones you, things like that, where you are hit by another car or you hit another car or a pedestrian again, or someone on a bicycle. So that's something to think about, but it's a good coverage to have because the likelihood of you in Western Pennsylvania, the odds of you hitting a deer are pretty high, but there's a lot of other vehicles on the road, of course, that pose a pretty large hazard as well. So having collision coverage, yes, it's expensive. Yes, you hope you never have to use it, but that is something that is really, really, in my opinion, crucial to have as part of your car insurance coverage because it's going to protect you against something bigger than an act of Mother Nature. So that's car insurance. Then you've got your homeowner's insurance or renter's insurance. So, of course, if you live in an apartment, sometimes people or your landlord may require you to have some level of renter's insurance. This would ensure your belongings in case something happened to your apartment. It caught on fire, there was a flood, et cetera, acts of Mother Nature, again, something catastrophic that happened, but you're covered or your belongings could be replaced in the event that happens. These are usually really cheap to keep in place because you're not insuring the actual dwelling, you're just insuring your belongings. And you can usually select, of course, the level of coverage that you have, and you just kind of assess a high level value of all of your possessions, and that kind of dictates what benefit you might need in case of an emergency. And then there's homeowner's insurance. So if you are a homeowner, there's lots of different components to homeowners insurance. So I'm not going to cover every single one of these, but to some extent, you want to cover your possessions and your dwelling. You also probably want to get some level of liability coverage in case you have a dog and a neighbor kid comes onto your property and your dog bites the kid. Liability coverage would cover something like that, or your homeowner's insurance in general would cover something like that. But it's something, an incident that happened on your property, so you would want your insurance coverage to pay for that. So that's part of the homeowner's insurance. And there's a lot of different considerations that go into how much coverage you need for your homeowner's insurance. But in general, you should be thinking about covering at least 80% of the value of your home, if not more. I think you should cover 100% of it, but at very bare minimum, it should be 80% of the cost of the dwelling of your home. Now, there are some things, some catastrophes that are not covered by home insurance. Most of them are, but there are certain things that are excluded from your homeowner's insurance that you may need to get standalone policies for. Things like flooding. I think termites might be another one of those things. Sometimes people need extra fire coverage. I don't know if there's any kind of tornado insurance, but if you live in the Midwest, you might need something that would cover you against a tornado causing a loss. But flood insurance is a big one, or something for hurricane type protection in Florida. I imagine that's very expensive to have some kind of flood insurance, but it's necessary because that is an extremely flood-ridden part of the country. So those are things to consider, and it just depends on what your policy will cover. But just know that there might be some things that might be excluded from a base level of homeowners insurance. And typically, if you have a mortgage, a lot of the times, most of the time, your insurance premiums get rolled up into your mortgage payment in addition to your property taxes. So when you go to purchase homeowners insurance, they will usually ask you who is your mortgage broker, and they will directly tack on your premiums for your homeowners insurance onto your mortgage payments so that you don't have to pay a separate bill every month. You just pay one bill for all of those things, for the principal and interest on your mortgage payment, your taxes, and your insurance coverage. If you don't have a mortgage, though, obviously, you're going to have to buy that policy alone. So, and again, your house is a huge asset, and you want to have a good amount of protection against anything, again, that Mother Nature could throw at you. We've had a lot of storms in Pittsburgh recently. This has been a really rainy summer for us. So I have to imagine lots of people are needing roofs replaced if trees have fallen down, or siding, shingles replaced. So these are things that, again, you don't want to have happen, but in the event that they do, I want you to have the proper coverage to do that. Now, when I'm reviewing someone's financial plan, these aren't typically things that I address, but I want to at least know that you have these coverages just in case something happens. But I'm more concerned about your health insurance and your life insurance, because these are things that they're impacting you, of course, right? Like it's insuring your life, your health. But these ancillary coverages, this property casualty, is a huge part of this too, because you're wanting to protect the things that you've purchased. And they're big, again, they're big purchases. Or if you have a boat, that's a big purchase. So I want you to be able to, in the event that something happens to your boat, have coverage so that you can be made whole again. That's kind of the purpose of insurance in general, is to make you whole again after a catastrophic loss. So in any event, having these insurance coverages is going to be crucial to the overall picture. And then one other component of property casualty is going to be your umbrella insurance. So umbrella coverage is exactly what it sounds like. So it is an umbrella that covers a good portion of your material assets. So it's going to encompass things like your home and your car and your boat and your jewelry, all of these things, but it's liability only coverage. So it's not going to protect the dwelling itself, the thing itself. It's purely liability coverage. They usually are $1 million of liability coverage, if not more. They're fairly reasonably priced, but could be an extra supplement and a sort of almost gap insurance policy that will cover you against things, again, liabilities that maybe your car insurance alone does not cover. So having an extra policy to fill the gaps can also be very important, especially if you have a lot of cars, or if you have a large home that you think, something detrimental happening could be really, really bad. You want to, have this extra coverage just to make sure that you are covered 360. So that's another thing to consider. You don't have to have that coverage, but it can be a nice addition, a nice supplement to all of your other property and casualty insurance coverages. And then let's switch gears. Let's talk about life insurance. So life insurance is going to obviously be insurance on your life, right? And they come in a couple different flavors. So I want to talk about term insurance. There's something called universal life insurance, and there's whole life or permanent coverage. And there's a couple different subcategories that go along with these as well. So let's start baseline with term insurance, because this one is it's very simple to understand. They're cheap typically. And these are we say term insurance is for term needs versus permanent insurance is for permanent needs. So a lot of the times young people can really benefit from a term policy because you pay the premiums. Again, they're pretty cheap. I think mine's like $30 a month for my term policy. $30 a month for, a few $100,000 of a death benefit. But it's enough that if I passed away, my mortgage could be paid off. So I am wanting to ensure that for term needs, for something like a mortgage or student loans, other debts, or even just the loss of income that may come from if you're a single if you're married but a single income household, if that person who's the income earner passes away, I want you to have enough term coverage that could sustain the surviving spouse for quite a bit of years so that they wouldn't feel the effects of losing that income. So when you have term insurance, it's usually for a certain number of years. There's a term on the policy. So it's usually 20, 30 years, something like that. And at the end of the term, you can either choose to shut the policy off, where you kind of just stop paying your premiums and the policy just goes away, or you can choose to continue paying those premiums. It's just that after the term ends, your premiums will skyrocket. So the insurance company is wanting you to give up that policy. They're betting against you that you will outlive the term of that policy. So that's the trade-off there, and that's why it's so affordable, is because the chances of you passing away when you're 30 are probably not that high. And as I mentioned in my last podcast, the more likely scenario is that you become disabled and now you can't work, or you can only work part-time, something like that. But the insurance company knows that, and they are banking on you, again, outliving the term of that policy. So there's no cash value associated with a term policy. It is purely just life insurance. So again, if you pass away, of course, the insurance company is going to pay out that death benefit to your beneficiaries. But if you outlive the term, you stop paying the premiums and the insurance coverage goes away. You don't get anything in return when you forfeit that policy. So it is purely just, most of the time, term insurance gets people to retirement. So again, I'm protecting against loss of income. I'm protecting against my mortgage needing to be paid off and the other spouse not being able to afford the mortgage just on their income alone. If you're in the military, things like that, where you're maybe the breadwinner of the household, that's your surviving spouse is probably going to feel the loss of your income. If they are not working, or if they only work part-time, or for childcare. If they are able to work, but they need childcare, they still need probably extra funds to fund childcare, because childcare is very expensive. So there's a lot to consider there, but most of the time, again, term insurance is good for young people who are healthy and who probably are going to outlive the term, but it's something that's nice to have. Your employer may offer some group life insurance that it functions like a term policy. So if you leave that employer, typically that policy is gone, but while you're working for that company, you will get to keep that coverage. Now, it depends on the employer of who is going to be eligible to get insurance and for how much. It's just going to vary based on the employer. Sometimes it's a $50,000 death benefit that they'll offer at little to no cost to you. Sometimes it's a multiplier of your salary. So sometimes it's a 1x, 2x, 3x of your salary. But typically, you might even be able to extend that coverage or expand it, where if they only offer $50,000 of a death benefit that you don't have to pay any premiums on, but they offer you additional coverage that you can add on top of that, you can always pay additional premiums if they offer that and get a higher death benefit. It's just that you might have to pay a little bit out of pocket. You may have to go through underwriting to get approved for that extra death benefit, but typically a lot of employers do offer that. So it just depends on what your employer offers, and it's worth looking into for sure. But a lot of the times you might need a standalone policy as well, just to supplement whatever you have. So again, worth exploring for term insurance. But there's almost no strings attached to a term policy, right? Like, you get to just pay your premiums every month, and at the end of the term, nothing really happens. You don't get your premiums back, but you just forfeit the policy. So there's nothing that happens whenever the term expires. Then there's whole life. So whole life is going to, of course, insure you for your whole life. And these typically have higher premiums because the insurance company knows that eventually, when you have this policy, eventually you're going to pass away. If the assumption is that you keep this policy for your entire life, the insurance company knows that they're going to have to pay out a certain death benefit at the end of your life. So they require you to pay higher premiums than a term policy might. It might be $300 a month. I'm making up numbers. It depends on the level of coverage that you have. But just note that those premiums are higher. Now, with higher premiums also comes a special benefit called a cash value. So on whole life, a lot of the times, some of your premiums are going and they're paying for the cost to keep the insurance policy valid. And then some of those premiums are going into a little bucket for your cash value. And so as you pay premiums, that bucket continues to increase in value. If you want to get rid of that policy, you can surrender the policy and get the cash value as a kind of reimbursement almost. So you're building up almost an investment account. Now, it's in traditional whole life, that money is not invested in the markets, but you have a little pot of money within that policy that you can pull from, and you can also surrender the policy and get the entire cash value back. And so whenever you get your statements, it'll tell you what the surrender value of that policy is that you would get if you called them today and said, hey, I don't want to keep this policy anymore. Here is what you would get in return for that. Now, when you're considering different types of whole life insurance, can be for maybe older people or younger people too. If you are a young person and you want a whole life policy, you think a term policy isn't good enough, isn't going to suit your needs enough, you can still get a whole life insurance policy when you're young, and it's actually going to be better in terms of the premiums. The premiums are going to be more affordable because, again, the insurance company knows that you're going to pay them for a really long amount of time. And again, the odds of you passing away soon are probably pretty slim. So they know that you're probably going to pay premiums for the next 40 years, and they're okay with a slightly lower premium versus someone who's 60, 65. Your premiums might be higher because you have a shorter life expectancy than a 30-year-old. But if you like the idea of keeping that coverage forever, this is a really great way to have a tax-free, this is across all insurance too, all life insurance, tax-free death benefit to your beneficiaries. So this is another almost wealth-building tool that you can keep in your back pocket as part of your overall estate. So some of people's largest assets is their homes and their insurance coverages for life insurance. So that's something to keep in mind too, is this can be a really great estate planning technique, is having some level of a death benefit that passes on tax-free to your beneficiaries. And then in the world of whole life, there's, as I mentioned, a couple different types of whole life. So there is something called variable whole life. So variable whole life, in this, it's the same as whole life, except that your cash value actually is held in almost an investment account where you get to select investment choices, and your cash value is going to fluctuate with the markets. Now, it's not guaranteed that your investments, quote unquote, your cash value is going to increase over time. Now, of course, you're going to be putting more money into the cash value, but because it's going to fluctuate with the markets, there's no guarantee that your cash value is going to increase over time. But this can be another great investment vehicle that also has that death benefit associated with it. So that's also something to consider if you like the idea that your cash value may continue to grow at a higher rate than a traditional whole life insurance policy, where your cash value is going to grow by a little bit, but not nearly as much as it would if it was invested in the markets. So that is something to consider in that realm. There's also what's called universal life insurance. So universal life insurance is kind of the intermediate between term and whole. So if you don't like either one of those options, universal might be a good happy medium. So universal has flexible premiums where if you become disabled and you can't work anymore and you can't afford your premiums, you can stop the premium payments on those, and the policy with your cash value will kind of pay for itself in the interim. So it's kind of the best of both worlds, right? You get the cash value that will grow over time, but you also have flexible premiums that you can pay or not pay and still keep the policy in force. Then you can kind of combine variable and universal life insurance, right? So you can have variable universal life insurance where not only do you get those flexible premiums, but now your cash value is invested in something and it's going to fluctuate with the markets. So you get the best of both worlds. But again, it's going to probably depend on your needs, and it's going to depend on how much a month you're willing to pay. You can also have paid up policies where you kind of put in a lump sum and that's your premium that you pay one time and that is it, in exchange for that higher death benefit. But it is paid up, so you don't pay any premiums. There's also things like 10 pay, 20 pay, where you pay premiums for 10 years and then the policy is paid up. 20 years, same thing. You pay for 20 years, then it's paid up. But it's going to depend on your needs. And again, Raquel from our office can certainly help you navigate that. But in general, especially for people who are still working, I want to, in general, make sure that you have enough life insurance coverage that if something happened to you, your spouse would be okay. That's my main objective, is that if you come in for a meeting and you walked out of here and you got hit by a bus, that your surviving spouse and your children would be taken care of. So that's my goal in assessing how much I think you might need in terms of coverage. And I have a software that sort of projects that, of looking at the loss of income versus your assets and what your spouse might be able to draw from. Now, you're going to, of course, have survivor benefits on Social Security as well to take into account. If you're any age and you're caring for a dependent child, a child who's under 18, you'll be able to get a little bit of a survivor benefit from the deceased spouse. Once the child turns 18, though, that benefit does go away, but then you're able to pick it back up whenever you turn 60. So there's other factors to consider, but all of that's going to be taken into account whenever I'm reviewing your financial plan, and specifically what happens in a survivor type situation where we're looking at what happens to your surviving spouse. And then the last thing I wanted to cover is business owners. So business owners, you have a unique set of risks that you've taken on whenever you opened up your business. And the type of coverage that you're going to need is going to depend on the type of business that you have. If you own a sole proprietorship where let's say you make jewelry out of your home, you may not need as much liability coverage as someone who owns a bakery where you've got industrial ovens and you have lots of employees that need to be covered as well in the event that something happens to those ovens. So you may need a different set of insurance coverages. But there are lots of different types of business insurances that you should consider whenever you are starting your business. Of course, again, if you're going to have a storefront, you're going to need your liability coverage, of course. You're going to need coverages against vandalism, theft. If you have someone that breaks in, you would need extra coverage for that to cover the losses of whatever was stolen. Again, if you have something where there's a lot of fire hazards, fire insurance can be another one here under the liability umbrella. Workers' compensation. For business owners who have partnerships, you might need something called key person insurance, or what's called a cross-purchase agreement. So a cross-purchase agreement, if you have two partners, the process of a cross-purchase agreement is you each purchase life insurance on the other person, so that in the event that one of those people passed away, that death benefit would be paid out to the other person, probably or should be in the amount that that person's share of the business was worth. So whenever you do a cross-purchase agreement, you want to take into account how much the business is worth, or at least how much your share of the business is worth, so that you can cover yourselves appropriately. Key person insurance would, if you passed away, would pay the business back for your share of whatever your interest in the business was. So there's a lot of different things to consider, and your lawyers, any insurance carriers could help you navigate that world. But again, you're going to have flood insurance. If you have a physical building, liability is going to be a huge one for you, because if something happens to a person on your property, a customer or an employee, you want to make sure that you have adequate coverage there to avoid a lawsuit, probably. So there are lots of different things to consider, but if you want more information on the types of coverage that specifically apply to your business, we can certainly help you navigate that. But it's would be a really lengthy conversation if I sat here and tried to detail every single kind of insurance that a business owner could have. It just depends on your specific business. If you have a fleet of vehicles, you would need extra auto insurance, some kind of corporate auto insurance policy. The list goes on. So in general, my goal behind exploring your insurance coverage across all of these different insurable risks is to just make sure that you are covered in the event that something happens to your home, to you, to your spouse, to your health, to your working ability, to your properties, your car, any watercrafts, things like that. I want to make sure that you are covered against anything that Mother Nature or another person has in store. And I want you to just be prepared. So if you enjoyed today's episode or you want to get more information, you can always visit us at ytswealth.com. Watch your assets on all social media platforms. Give us a like, give us a follow, and we will see you on the next one.